Hi and Assalamualaikum. My name is Akmal Hakim bin Nur Hamid Maulana, student Bachelor of Science Horns Plantation Technology Management in Semester 6. In this video, I would like to share about an analysis of corporate financial performance consists of a trend and comparative study between Woodlandor Holding Berhad and Mobilia Holding Berhad. For the Woodlandor, the company is a private limited company founded in the 1980, has mostly been involved in the manufacture of wood-based goods for the building and construction sector. Woodlandor Group has been marketing a wide range of wood-based goods to meet varied demands and requirements in both Malaysia and overseas market, ranging from timber fire resistant door sets to prefabricated timber roof truss to DIY furniture. For the second company, Mobilia Holdings Berhad, it is a holding corporation. The company produces wood-based furniture such as wooden upholstered furniture with fabric and polyurethane cushions through its subsidiaries. On February 6, 2020, it was founded in Malaysia under the Companies Act 2016 as a private company limited by shares under the name of Mobilia Holdings Sdn Berhad. On 11 June 2020, the company was converted into a public limited company and assumed their present name as Mobilia Holdings Berhad. They are an investment holding business and their subsidiaries are primarily involved in investment holding, furniture design, manufacturing and sales. Trend analysis for Woodlandor Holdings Berhad. First, liquidity ratio. In the liquidity ratio have two ratio, which is current ratio and quick ratio. In the current ratio, as you can see, the table and the bar chart shows the current ratio is the same from 2017 and 2018, as well as in 2020 it is declining. This is because in 2017 and 2018, the company will be able to meet its current liabilities with its current asset. In 2020, it found the lowest ratio of 1.76 and showed less liquidity but did not increase depending on operating cash flow and external borrowings, due to the good ratio of 2.19 in 2017 and 2018. This proves that the corporation can meet its current liabilities with existing assets. The higher the number of ratio, the more liquid to meet current liabilities. Thus, values greater than 1 are preferred. In the quick ratio, as you can see, the table and the bar chart shows in 2017, the quick ratio is low compared to 2018, which is up. In 2020, a lower quick ratio means less liquidity than 2 years before. This indicates that the corporation cannot meet its short-term obligation without relying on shares. Higher quick ratio in 2018 indicate greater liquidity. The higher the ratio, the financially strong the company, and the lower the ratio, the more likely the company is to have trouble making debt payments. The higher the number of ratio, the more liquid to meet current liabilities. Furthermore, values greater than 1 are preferred. Second ratio is a activity ratio. In activity ratio consists inventory turnover and average collection period. In the inventory turnover, as you can see, the table and the bar chart shows inventory turnover shows an increase in rate in year 2018. This suggests that companies use inventory effectively to generate sales and use and hold unproductive stock surplus ineffectively. It also in 2018 shows good performance due to higher ratio and the company has enough to use inventory to generate sales. When the ratio are high, money tied up in stock and can show the effectiveness of inventory management. Compared to the industry situation, highly successful inventory management can imply a high inventory turnover ratio. In the average collection period, as you can see, the table and the bar chart shows that the average collection duration dropped from 106 days to 19 days between 2017 and 2020. As a result, it may be concluded that the company's credit sales and cash on hand management in 2017 and 2018 were inadequate. As a result, if the firm handles its credit sales efficiently in 2020, the number of days will be reduced. Payments are received faster by the agency when the average collection time is low. Third, leverage ratio. In the leverage ratio consists debt ratio and debt to equity ratio. For the debt ratio, as you can see, the table and the bar chart shows the debt ratio declining from 2017 to 2020 implies that the firm has the lowest debt ratio, indicating that it is effective in managing its debt and pose a smaller financial risk. The debt ratio was high in 2017 at 3.82%, indicating that the corporation is not excellent at managing its debt, resulting in increased financial risk. Furthermore, leverage is an effective way for business to thrive, and many are seeking for a long-term debt solution. Conservative companies have a lower debt to equity ratio. Next, in the debt to equity ratio, as you can see, the table and the bar chart shows the debt to equity ratio decreased from 2017 to 2020, which may be seen as best management. It demonstrates that investors like creditors finance operation. This might indicate that investors desire to fund corporate activities since they are not profitable. The greatest debt to equity ratio was in 2017, suggesting that more bank loans were used for borrowing financing than investor financing. The year with the lowest debt to equity ratio is 2020, which indicates more financial stability. Fourth ratio is a profitability ratio. Profitability ratio consists gross profit margin and net profit margin. In the gross profit margin, as you can see, the table and the bar chart shows from 2017 to 2020 it shows a declining in profit margins, but in 2020 it shows a high declining. This is because the company has a low ability to pay interest charges levied on debt used in 2017 and 2018. The ratio was lower in 2017 and 2018 because the firm had poor performance and a declining in sales volume. But the company is in decline in 2020 because the company will not make a reasonable profit on revenue if it keeps operating costs under control. Next, net profit margin. From the table and the bar chart shows, it exhibited a net loss in net profit margin from 2017 to 2018, but a little decrease in net profit margin in 2020. In 2020, the company's net profit margin is its lowest, implying that it makes fewer profits and does not create more cash for shareholders, implying that it has an inefficient cost structure or a poor pricing strategy. As a result, low ratio may be the result of poor management. Trend analysis for Mobilia Holdings Berhad. For the current ratio, as we can see, the table and the bar chart shows from 2017 to 2020, the current ratio shows a declining rate. Throughout the year shows a rate higher than 1. This indicates that the company can meet its current liability well with the current asset available. In 2020, lower ratio indicate less liquidity, which does not mean greater reliance on operating cash flow and not meeting short-term obligation compared to 2017 and 2018. 2017 showed good performance due to higher ratio. This indicates that the company can meet its current liability well with the current asset available. Next, quick ratio. In comparison to 2017 and 2018, the rate in 2020 is lower. This suggests that the company's short-term commitment cannot be met without the use of prepaid inventory and costs. In 2020, a smaller quick ratio suggests less liquidity. This demonstrates that the organization is capable of meeting its short-term obligation without relying on prepaid inventory or costs. In 2018, higher quick ratio suggests more liquidity. Inventory turnover in activity ratio shows that from 2017 to 2018, inventory turnover showed an increase in rates. This suggests that companies are using inventory effectively to generate sales in 2018, while in 2020, companies are not effectively using and holding back unproductive stock surplus. A lower inventory turnover ratio compared to industry norms may indicate less effective inventory management. 2018 showed excellent performance due to higher ratio. This shows the company is practically using inventory to generate sales. Alternatively, a high inventory turnover ratio may mean the business does not have sufficient inventory, so profits can be affected by shortage. Next, average collection period. Based on the table and the bar chart, from 2017 to 2020, the average collection period increased from 22 days to 40 days. Then in 2017, it showed a decrease to 22 days. So here it can be analyzed that in 2017, the company was not good at managing its credit sales and more cash on hand. Thus, in 2018 and 2020, the company increased the number of days because it managed its credit sales incorrectly. This is also an expensive situation because the company has to take on debt to meet its commitment, and this debt carries interest charges that will reduce revenue. Based on table and bar chart, in debt ratio shows that from 2017 to 2020, the debt ratio showed an increasing and decreasing rate. The year 2017 showed that the company had the lowest debt ratio, which means the company was useful in managing its debt and showed lower financial risk. In 2020, higher debt ratio, which can be analyzed as companies are not good at managing their debt, lead to higher financial risk. At the same time, leverage is an efficient method used by companies to grow, and many firms are looking for sustainable use of debt. Next, debt to equity ratio. From the table and the bar chart showed from 2017 to 2020, the debt to equity ratio increased, which might be seen as dangerous. It is because that investor does not finance operation in the same way that creditors do. In other words, unlike lenders, game investors do not have a large sum of money. This might indicate that investors are unwilling to fund corporate activities since they are not profitably. The greatest debt to equity ratio is in 2020, showing that more bank loans are utilized for borrower financing than investor financing. It reveals that 2017 has the lowest debt to equity ratio, indicating that the company is more financially solid. Fourth ratio, which is profitability ratio, consists gross profit margin and net profit margin. In the gross profit margin, the table and the bar chart shows profit margin increased from 2018 to 2020, yet in 2018, they decreased somewhat due to the company's inability to pay interest costs assessed on utilized debt in 2017. Due to poor performance and a drop in sales volume, the ratio began to declining in 2018. However, in 2020, the corporation will begin to increase its gross profit margin since it will be profitable. Investors want to pay a greater price for a company with a large gross profit margin. Based on net profit margin table and bar chart, the company's net profit margin decreased from 2017 to 2018 but improved somewhat in 2020. Because the firm has stronger development possibility and can provide net income for shareholders, it is a superior investment. They can achieve this is by increasing income while keeping constant expenses, or by maintaining steady sales with lowering costs. The company's net profit margin was the lowest in 2018, indicate that it makes fewer profit and creates less income for shareholders, implying that it has an inefficient cost structure or a poor pricing strategy. Cross-sectional analysis for Woodlandor Holdings Berhad and the Mobilia Holdings Berhad in the year of 2020. First, for the liquidity ratio and current ratio, the current ratio of Mobilia is higher than Woodlandor in 2020. Company Mobilia shows a rate of more than 1. This indicates that the company has higher capacity. It meets its short-term obligation in the future, and the Mobilia company can also meet its current liability well with existing asset by 2020. Increasing the current ratio over a period may mean better business liquidity or a more conservative approach to working capital management. Thus, a downward trend in the current ratio in Woodlandor may suggest a declining liquidity position of the company or a linear working capital period by adopting more successful management practice. Next, for the quick ratio, from the table and the bar chart shows that Woodlandor quick ratio is lower rate than Mobilia company. Woodlandor show low quick ratio quality, indicating that the entity may not pay its current liabilities by using its existing asset. This indicates that the company does not have sufficient liquid asset to pay current liabilities. Therefore, if the ratio is more significant than 1, the entity's current assets are higher than its current liability after deducting inventory. Higher quick ratio in Mobilia indicates greater liquidity. This can analyze that Mobilia show higher rates because companies can meet their short-term obligation well without relying on their prepared inventory and expenses. Second ratio is a activity ratio, which consists inventory turnover and average collection period. Based on the table and the bar chart for the inventory turnover, shows Mobilia has a higher rate than Woodlandor. Woodlandor companies show low rates because companies are not using inventory effectively to generate sales starting in 2020. Woodlandor companies' inventory turnover is lower, meaning companies are running out of shortage in products or perhaps excess stock. It is also higher for Mobilia than Woodlandor for 2020, as it is considered a positive measure of successful inventory management for 2020. However, higher productivity does not necessarily mean a higher inventory turnover ratio. This can also mean a shortage of stock, which can lead to declining in yields. Based on the table and the bar chart, the average collection period of Mobilia is lower than that of Woodlandor companies. This shows that the Mobilia company is good at managing them is its credit sales. A lower average collection period is usually better than a higher average collection period. The SCP is too high for a Woodlandor business for 2020, as it suggests some potential issue for the company, such as the company not being good at handling its credit sales and having more cash on hand. Furthermore, this high amount that their customers no longer want to pay or may not be able to pay is a serious issue for any business. Third ratio is a leverage ratio, consists debt ratio and debt to equity ratio. Based on the table and the bar chart debt ratio, Woodlandor has a lower debt ratio than the Mobilia firms. This implies Woodlandor business are better at managing their financial debt structure and are less likely to default on the debt. Debt ratio analysis analyzes a company's capacity to pay its debt by expressing the connection between its total debt and asset. Lower ratio are desirable in general because Mobilia high debt ratio indicates a high probability of insolvency, since excessive debt will result in a significant debt repayment load. Next, based on the table and the bar chart for the debt to equity ratio, it reveals that Mobilia debt to equity ratio is excessively high when compared to Woodlandor. According to the comparison, it tends to display high risk firm or stock to shareholders, which is unprofitable since it implies the industry is more reliant on external lenders, putting it at more risk, especially at higher interest rate. Woodlandor have a lower debt to equity ratio as corporation gives more funding. This means reduced risk for the organization, which may lead to improved money security and more financially stable company. Last ratio, which is profitability ratio, which consists gross profit margin and net profit margin. From the gross profit margin, at the table and the bar chart shows Mobilia company can regulate the cost of items supplied compared to its sales income. Its gross profit margin is better than Woodlander's. Profitable operations, lower manufacturing costs, a rise in marketing pricing, or an undervalued surplus inventory can all be attributed to higher gross profit margin. Higher production expenditure, lower sale price, and change in sales mix are all contributing to Woodlander reduced gross profit margins. All of these variables must be thoroughly reviewed and tracked throughout the year in order to avoid a situation with decreased gross margin. Next, the table and the bar chart for net profit margins shows Woodlander's net profit margin is lower than Mobilia's net profit margins. This is due to Woodlander's inefficient cost structure or poor pricing strategy. Cheap ratio can be caused by inadequate management, excessive spending expenses, and low pricing tactics created by enterprise unable to generate net income for shareholders. Mobilia exhibits a greater net profit margin since it was developed because a firm may successfully manage its pricing by delivering goods or service at a price slightly higher than its cost. As a result of effective management, low cost of spending, and a smart pricing strategy, high ratio will result in improved growth possibilities. For the recommendation, from the observation, Woodlander company has the lowest liquidity ratio. Restructuring debt, utilizing idle money, and cutting costs are all potential strategies for raising cash for the Woodlander. Minimal spending cuts, the sale of non-essential assets, and the accumulation of outstanding debt are all options. The Mobilia has a lower activity ratio than the Woodlander, which means that the average collecting period is shorter, but the overall asset turnover is larger. Improving the activity ratio may be done in a variety of ways, including increasing sales, increasing efficiency, and so on. By selling unnecessary assets and gathering outstanding accounts, removing short-term debt from the balance sheet allows a company to conserve more liquidity and put it to greater use in the short. The leverage ratio thus suggests that Woodlander has an issue that must be addressed in order to improve the company. By evaluating the income statement, one strategy for improving the debt ratio for the Woodlander firm is to analyze the company's budget to see if projected cash flow will continue to satisfy continued debt obligations. Low leverage ratios are preferred by both investor and lenders since lenders' interests are better protected in the event of a business failure, and shareholders are more likely to recoup at least some of their initial investment if the firm fails. A company's ability to raise additional capital may be hampered by high leverage level. In the conclusion, ratio analysis are important financial analysis method for analyzing a company's performance and financial status. Comparison of a company's performance to that of its peers, while also comparison of a company's performance over time are in-depth possible with financial ratio research. Liquidity ratio, activity ratio, leverage ratio, and profitability ratio are four important financial ratios that have been utilized. The liquidity ratio assesses a company's capacity to satisfy short-term obligations. The success of a company effort, such as receivable collection or inventory management, is then measured using activity ratio. The leverage ratio analyzes a company's debt to its asset, equity, and profit to see if it can expand over time as pay of long-term debt and interest. Finally, profitability ratio are used to evaluate a company's capacity to generate revenue and profit from its asset. It is a step in the credit rating process that focuses on the ratios used to identify and value debt and equity instruments. Ratio for each division can be determined to assess how well a company's units are performing. The result of a financial analysis may be utilized to forecast future profitability and cash flow.